Welcome, everybody. I'm super excited to have the wonderful Kerry Bridgland back on the show with us today. Now, I don't know if you guys remember, we had an awesome interview with Kerry a little while ago where we were talking about self-managed super funds, wasn't it, Kerry? It was
Yes, it
self-managed
was.
super funds and the $3 million barrier at that time. So I've asked Kerry to come back and have a chat with us because towards the end of that interview, we were talking about financial literacy. And Kerry said, more people need to know about this. And I said, well, here's a platform for you, Kerry. Let's talk about this. So Kerry's going to join us today. And for those of you that don't know who Kerry is, Kerry, do you want to just give us a quick 2 minutes on who you are and how you'd like to present yourself?
Yeah, definitely. So obviously Kerry Bridgland from Bridgland Finlay Accounting. We're an accounting firm here on the Gold Coast in Burleigh Heads. We've been in business nearly 15 years now, my business partner and I. And I'm very interested in all things, not in tax, but financial literacy, investment, super, retirement, a more holistic view on people's finances and goals, etc. So that's about me. I'm very passionate, not just about tax, like I said, that's one part of my business, but more about structures, goals, retirement, income, negative gearing, the whole kit and caboodle. So that's sort of my passion and my interest.
So you're essentially an accountant, but the lovely thing about Kerry is she's not just an accountant. She does everything and more. So Kerry, tell me, okay, let's just go back. But look, let's dial back. Financial literacy. What do you perceive as financial literacy?
Yeah, so of course there's a definition and everyone's got their own definition. So the reason I thought of the word financial literacy is I've been in tax a long time now. Oh, geez, going on 30 years. 30 years in tax, people I found, don't really understand very little about finances, very little about budgeting, very little about legislation, very little bit about their retirement. We have superannuation in Australia, which is around for years, and everyone retires on their super. They don't know how much they're getting taxed. If they're getting taxed going in, if it goes in after tax dollars, is it taxed? The earnings, what are they taxed? When can I get access to my super? How much super can I access? How much can I put into super that's tax deductible? So I started thinking that, there's more to tax and to financial literacy than just budgeting cash flows and retirement. It's like, how do I want to retire? What do I need to know before I retire? How much money do I need to retire on? What can I do to grow my retirement while I'm working? What are the lifespans of my life? When should I be putting money into super? When should I be drawing money out? There's so many questions and there's no answers. And
Okay.
if somebody wants to go, yes,
So let's break that down and
Mm.
let's start from the beginning. What is the
yes.
most common mistake that you see when people want to head for their retirement that they've made that they could have done earlier? So let's say we're speaking to somebody in their 20s and their 30s. What would your advice be?
Probably not to touch super. Probably not to go anywhere near super in your 20s or 30s. You've probably got children, young children. You've probably got a very large mortgage that's non-tax deductible debt with interest. My advice would be not to really, you don't really need to know anything about super at that stage. So that's when you talk about financial literacy, it's like, what do I need to know? Okay, how can you grow your nest egg? Okay, there's negative gearing. What's negative gearing? When should I be negative gearing? What kind of cash flow do you have to negative gear? So there's different lifespans and cycles. And I think it's knowing what to do at which cycle.
Let's break that down for the audience
Yes.
and tell them or give them some meat on the bones there. You say, don't worry about super. So 9 times out of 10, somebody that's in their 20s or their 30s are probably going to be in an industry super. When would somebody open a self-managed super? Maybe when they're a little bit older, when they get into their 40s.
There's no
start
there's no rule of thumb, but usually ethically and sort of morally, we say you need about $250,000, $250,000 in
Okay.
super to
Yeah.
start thinking about a self-managed super fund. And that's just usually when you've got that much in super, your fees are going to be similar to the accounting fees and the audit fees outside of your industry funds. So it becomes more economical. And then with 250,000, the reason you want your own self-managed super fund is, let's be honest, mainly to borrow or to control your investments.
Your
You get
investments
your own
or your
say.
retirement, basically.
Yes,
To
of
control
course.
your later years. But now
Of course.
what about people that don't have self-managed super funds or have started a little bit late or they've got industry funds and they're purchasing properties? We're talking commercial property. This is all about commercial. A lot of people we see are purchasing residential properties. Most of those they're purchasing their own names. And often by the time they come to us, they're sort of in their 40s, 50s, whatever. And we usually steer them towards an entity, purchasing a property in an entity. What would you say? Would that be the right advice? Or do you think that at that point that they should be purchasing a self-managed super fund?
If they're 40 or 50 and they've already got assets and money, definitely a self-managed super fund. Definitely. Yeah, 40s or 50s.
What would the advantages be in a self-managed super fund versus an entity, company and trust?
No capital gains tax when you retire. So when you sell that investment, it's tax-free.
Right. Okay. So there's
And no other entity do you get tax-free when you sell an investment.
what if the intention is never to sell the investment?
Then you're just leaving a headache for your estate.
So you're leaving it for
Our advice is to cash out. When you're starting to get unwell, you liquefy. You liquefy for yourself, you liquefy for your family, you liquefy for everybody else involved after you pass. The property is no good to you when you're dead.
Yeah.
So my advice would be we liquefy. So we sell all the assets, you get them all tax-free.
Yeah.
You give all your money to your children.
Now that's what you would do in a self-managed super fund. What if you've set
Yes.
up an entity or a trust for, let's say, you want generational wealth? So you want to pass those properties down to the next generation.
So what, they buy into that entity or they'd be a
Not
shareholder there?
Yeah, they'd be a shareholder of the entity, beneficiary of the entity. I mean, if you pass on and you're the director of the entity, you could make them director of the entity before you pass on, couldn't you?
You could. It's not something I see very often. It's not common. No. Most people are saving for themselves. And if anything, they give cash to their children before they die. They don't normally give them properties. It's not common to give properties because everyone's different in what kind of management level they want to do or what kind. Like you never really have parents and children on, and you probably be aware of this yourself with your children. They're not usually on the same level as you. So what my parents invested in and what they did, I wouldn't do the same.
Yes.
So it's not something that you would, it's like leaving a horrible old couch, it's been in the family for hundreds of years. It really is. So, it's like,
Not when the horrible old couch is worth a couple of million. I think
well, it's
it's
still,
one
but
the
then
horrible
they've got
old couch.
it might need some work done. They've got body corporate issues or, so it's not usually intergenerational wealth. You normally start looking at properties when 40s and 50s. And then from there on in, and you take them to your 70s, 80s, 30 years later, there's no loan, they're unencumbered, they're worth 3 times more or 5 times more than when you bought them, and you sell them tax-free. Why wouldn't you? Like in another entity, you'd probably pay the capital gains. You might leave them to an estate. I'll be honest with you, I've seen quite a lot of estates. Obviously, being an accountant, my clients pass. 99% of the children will sell. The estate will sell everything and give them the cash. So the estate pays the capital gains. Yeah. And they get the net amount. So
Yeah.
99.9% of the time, the estate will sell everything because also, once again, it stops cobbling. Let's say there's 3 properties and 2 want to buy that business and stay in and keep the properties. One daughter doesn't, or one's a foreign investor, so they can't hold property or they're taxed differently. Kids could be living all over the world by that stage. So it comes with a lot of problems if you are trying to intergenerational wealth, actual property, bricks and mortar.
So for clients that want intergenerational wealth, they're buying properties for intergenerational wealth. What would you advise? What entities would you advise that they're buying them in?
Oh, then I'd definitely say the super fund. Most definitely, 100% in the super fund because the fact when they are sold, they're tax-free.
And again, I'm saying intergenerational wealth, intergenerational investment properties. When mom and pop die, pop their clogs, if those properties were to stay in the self-managed super fund and the kids are in the self-managed super fund, there's no transfer of funds, or is there?
There is. No, there is. So if you're
explain that to us.
Yeah, so if you're over 18 years old and you're not a dependent on your parents, when your parents pass, their money in the super fund has to be given to you as a death benefit. So that's taxable to you. So when they talk in Australia, there's no inheritance tax. That's not correct. If you die with money in your super fund, even if your children are in that big fund, that money is in your member's balance. So you have a pot. So to say there's 4 of you, so 2 children, 2 adults, 2 parents. The parents have their members' balance, the children have their balance. When the parents die, their balance doesn't just transfer over. It literally gets sold. The tax is paid on anything because they're dead. It becomes a death benefit payment over, and the tax can be, I think it's on untaxed and taxed amounts, could be 15 cents in the dollar or 30 cents in the dollar.
Wow.
So you couldn't keep that property anyway because you've got to pay the tax on it. You'd have to find the money to pay that. So it doesn't work that way.
So it really doesn't work that way. And if
No.
parents were to I've asked you this earlier, but just clarity. So if they don't have that property in a self-managed super fund, if it's in an entity and the parents put those kids in as directors or co-directors in the journey of that property and the parents pass, surely the kids wouldn't pay tax.
No, because the entity owns that property
Yes.
then.
Yeah.
Yes.
Okay.
So in the case of a super fund, the member owns that property. The
Right.
member who's got the biggest balance
Yes.
owns that technically.
So there are kind of pros and cons. I mean, if you're wanting intergenerational wealth and your kids are interested in your investment portfolios, you can put your kids in once they're over the age of 18 as directors.
You see, the problem there is you've got to get them in as shareholders as well, because if you want them, because the shareholders are the ones that receive the benefit from that entity. The directors control the entity, the shareholders own the entity. So you've got to get them in as shareholders. And if you bring them in late as shareholders and that company, say, has got a net wealth of $5 million, they're going to have to buy in. They don't get those shares for free.
Ah, okay. And
Yes, yes. So let's say you've got 100 shares and it's
Yep.
worth 5 million. You can't just give your kids 50 shares for zero. They've got to pay half to get in.
Oh, so you can't just donate them to your
No,
kids.
no. That's tax evasion.
So there,
It's illegal.
there's no ways of getting your kids into those entities.
No, but like once again, I don't know what your clients are like, but I've been in tax in Australia for 30 years. It doesn't happen. Kids don't want parents' assets. They want cash. They want to do it themselves. They want to make their own intergenerational wealth.
My kids are different.
Lucky you.
My
But see, it's good to pass over the properties. Properties are for you. Like, everyone wants to negative gear. Everyone should negative gear. Negative gearing's still here. We don't know for how long. So everybody should be negative gearing while they can, because when they do get rid of it, they'll grandfather it. So whatever you've got now,
Yeah.
they won't take from you. But there's already talk of making it one investment property per person or stopping it altogether. There's so much to talk about negative gearing that something will happen in the future. So realistically, people have to take advantage of that now and start negative gearing now.
Well, Kerry, I'm sort of at odds about that because I go out there and I say, why would you want a negative gear? Because let's just take every dollar. If you're negative gearing, you're essentially paying, and this is just a round figure, 70 cents to government, and you're keeping 30 cents out of the dollar. So why would you want to do that if you've got, and this is why we talk about commercial property, because commercial ideally is positive gearing, where you are earning a whole heap of cash flow out of your positive geared properties. And going forward, those properties gain value over the years. However, I can understand if you do have a couple of negative properties to maybe balance them out, but we're still pushing towards positive gearing, not negative gearing.
Look, if you combine positive gear, the way negative gearing's worked in Australia for so long and has been so popular is because when you're earning the most income, you're happy to lose that money in a negative gearing because the investment's growing. So you are losing on cash flow. But if you look at capital gains every year unrealized, let's say the property's going up 10, 15, 20% every year, then you're getting that gross. And then what happens is when you're older and you don't need to negative gear anymore, it becomes positive geared at the right time as you're coming down your life cycle. Then it starts earning you some income. So it's like, great, now that I'm semi-retired, I've cut my hours down, I don't owe any money on this property anymore. I had my negative gearing and made my, I don't know, 20, 30, 40,000, $60,000 in tax savings over the last 10, 15 years. Now the next 10, 15 years going to be positive geared and I'm not earning as much down cycle and I'm going to get that money back. And I've got an asset that's now worth 5 times as much money when I sell it.
Okay, so essentially what you're saying is negative gearing is very good for those people who earn huge big salaries and want to diminish their tax. But if you're not earning that huge big salary and you need that cash flow to live on and you're investing in, let's say, commercial, or I've had quite a couple of people that have got residential portfolios that are now positive. Well, they're going to pay they're going to pay
Tax on that, yeah.
tax on the positive cash flow. But then again, I mean, if you're earning income, you're going to be paying tax on that income anyway.
Yes, you are. But if it's negative geared, it's the other. So it's whatever your appetite is for. So for tax purposes, we love debt.
Yeah.
We love debt, tax deductible debt.
Yep.
That's what we love. So we don't want more large mortgages in your own name for your residential property. You want the large loans in the commercial properties or the residential properties that you're negative gearing.
So in other words, if people are buying positive cash flow properties and they don't have any negative cash flow properties, it's a good idea to possibly buy cash flow or just put negative gearing properties into the portfolio to balance out the positive gearing that you're getting out of the commercial properties.
Probably, six. Well, there's so many variables, unfortunately. So if you would, especially if you were in, say, if you're going to have positive properties, companies don't get capital gains tax discounts right now. So a company tax rate is 25 pence in the dollar. The top individual rate is 47 something. Was it 45 plus Medicare levy, 47 cents in the dollar? So let's say you do have positive geared properties in a company. You're paying 25% tax on those. That's fine. Compared to if you're outside a company, you'd be individually paying tax at 47 cents in the dollar if you're in the highest tax bracket, you're a high earner. Do you have it in the company at half the tax, or do you have it in your own name? So really negative gearing is for large earners. Let's be honest these days. So if you're not making a lot of money, you want to put it in your own name probably then as well and get the positive geared. And then, like you said, if you're making too much money, maybe get a negative geared if you've got one that's going to grow in capitals. So that negative gearing offsets a positive geared, but they're both both going gangbusters together.
Yeah.
So really you're looking at the end goal, aren't you? You're not really worried about the plus
Immediate.
or the minuses throughout the rent. No, you're looking at 20 years' time when you sell, they're both tripled in value and you really haven't paid any tax in the interim either way.
Okay. So pretty much what you're saying is if you've got those heavily positive geared properties, which a lot of people have because they bought their properties during the COVID spike or just before the COVID spike, properties have gone up exponentially. They earn a ton of cash flow out of that. Now's probably a good time to purchase good investment properties, hold them, offset them, and ride the tide into later years.
That's correct. And that's also just a point to note, some negative geared properties, they're not cash negative geared, it's on the books. So if you buy into, say, a large, let's say, commercial space that has a lot of body corporate, so they've got a gym, they've got a gym on site, or they've got fountains and toilets and lifts and escalators, etc. on a commercial property, they all get depreciated. That's a non-cash expense. That's all on paper. So let's say, for example, their repayments were $50,000 a year, their rent was $80,000 a year, and less rates, etc. They're positive geared on paper. Then we go, oh, what about depreciation? Depreciation's $30,000 a year. They're not physically paying $30,000 a year. It's a journal entry. So now their positive cash flow property is now negative for tax purposes.
Right on. Now, what if you have two properties in one entity and the one is heavily positively geared and the other one is vacant, let's say? Okay, so you'd be offsetting the vacancy, whatever you're paying on the rates and the
That's correct.
whatever,
Against the positive.
Definitely. Not that I'm saying go out there and get vacant property, people.
No, but if it is vacant, or like we just said before with negative. So negative gearing's not always a bad thing. If you could be cash flow positive, but negative geared for tax purposes, because depreciation, you're not paying the $30,000 in depreciation. It's just a book entry.
Just explain that, just so that people get 100% clarity. I understand what you're saying, but just for 100%, let's just say that again. So you could be positive cash flow, but negative geared.
So once again, for an example, let's say your rent was $80,000. Your payments to the bank, your rates, everything, interest, etc., is $50,000. So on paper, you've made $30,000. But then you're in a commercial complex that has lifts and escalators and et cetera, so they can be written off every year. It's called capital allowances, depreciation. So let's say your depreciation schedule, especially if you're buying something brand new or very new, the depreciation's high. It gets lower as the building gets older. So if you're buying into a brand new, say in a shopping centre, commercial property in a shopping centre, there's going to be depreciation. Then you get the gates, the escalators, the lifts, everything gets depreciated on paper. So now you've got a $30,000 gain. You've got a depreciation report that you've got that says you can depreciate $30,000 a year on the assets that you bought into in the pool. So now your $30,000 profit becomes zero, but you've got $30,000 back in your pocket and you're not paying a cent of tax on that.
Correct. Also, Kerry, I just thought of something while you were talking about it. So if you're in that scenario and you've got a property that's got lifts and moving parts and gates and whatever, and the property is quite old, and those moving parts, I always call them moving parts, escalators, lifts, those kind of things, need to be repaired or replaced, that is also a capital a tax depreciation, isn't it?
That's correct, yes.
So the key thing to do over there would be to get your depreciations done before the end of your financial year end.
Definitely.
Oops, I've just slipped up on one.
You can always have it next year. It doesn't go away. It's still there. It's just timing issues.
Okay, so it just rolls on, basically.
Of course, you'll get it next year. Yeah, what you miss this year, you'll get next year. So it's just a timing thing.
Yeah. Okay, well, I think that is super valuable for people to know. And this thing about depreciation, because I think most people don't recognize that you should really have a depreciation schedule done on your properties at least every year pre-financial year end.
We're lucky in Australia, you can buy one that can go for like 25 years.
Ah, yes.
Yeah. Yeah. So you get it done once and it's set and forget until they do some major upgrades. And then obviously you get another one done after that.
But does that benefit you year on year?
It does. It's diminishing. I think it's the only way we do it. I don't think they can do them annually. I think here's a set and forget. So when it's first built, that building, there's a depreciation schedule given to that. And when you buy into that property or that high rise or that townhouse, whatever it is you buy into, you can then go either use theirs or you can get your own done. But it's the same thing. It's based on the assets that are there at the time. And then obviously if there was a major upgrade, you get a new one done. But it'd be for everybody, not just you, because you're all getting the depreciation. Every unit holder or house holder, townhouse, office holder has to have one of those reports given to them. So it's done on the large scale, and then you get your slice of the pie.
Okay. So, and don't forget to hand that slice of the pie to your good accountant.
Of course.
Make sure that you get your good slice of the pie back.
Yes, definitely.
So just going back to our topic of financial literacy, we think these are gold nuggets that we're talking about. Is there anything else that springs to mind that you think your average person out there should know?
Oh, there's tons. It's never ending. It's never ending. So, for example, today, my business partner and I have been talking about strategies we always do with clients. So people are working past 65 now. They never used to. Usually 65 was the age. We're living longer. We're healthier. We're happier. You can stay in jobs longer. Yeah, definitely. Of course. Yeah, of course. So people aren't just, sort of getting their pensions at 65 like they used to 10, 15, 20 years ago. So what people don't realise is 65 is a preservation age in Australia for you to receive your super. So you can go and retire at 65. So what we say to people who are still working at 65 is put your super into pension phase. Take your minimum pension out that you have to. So there's a few things here for people to digest. So when you turn 65, number one, you put the money into preservation and it goes into pension phase. That's number one. So what that means is all your earnings in that super fund are tax-free. So while you're working, they're taxed at 15 cents in the dollar, all your earnings in your super fund. That's called accumulation phase. So while you're in accumulation phase, all your money in your super fund is getting taxed at 15 cents. Once you hit 65, regardless if you're retired or not, doesn't matter, you hit what's called preservation age at 65. Now all those funds can be put to pension phase, from accumulation to pension. What that means is no tax on those earnings, 15% saving. But to get that tax-free status, you've got to take the minimum. So at 65, it's 4%. You've got to take 4% out.
So in other words, you've got to take 4% out over a 12-month period, so annually.
Yes. Okay. Yes, to get that tax-free status.
Whether that's a chunk or whether that's in little bites.
It doesn't matter how.
It doesn't matter.
Yep.
4%.
No, yes. So you take your 4% out. Now, the beauty of this is you're 65 and you're still working. So let's say your 4% is $35,000. So you take your 30, I'm going to put 30,000 back in as a tax deduction, as a super contribution, and offset that against my wages.
So hang on, wait a minute. So you can take 35,000 out.
Tax-free. Tax-free. And the earnings are free in the super fund. Yes. Yep.
And then just go and lump another 30 grand back in.
And get a tax deduction against your current salary and wages. So I did a calculation with a client today. It's about a $10,000 a year saving.
Wow.
And if you work to 70, that's $50,000 you've saved.
Gee whiz, that's amazing. That's
amazing. And so you can't learn that anywhere. No one's going to tell you that. And you don't know what to ask your accountant. So they're not just going to give you a whole blanket of things to do. They're not just going to give you a ton of strategies. It's not what they do. So this is what I'm talking about, financial literacy. And this is just one little pie. There's so many more. There's negative gearing. There's so many different things to be thought about. And so this is just one aspect of it. But you can't learn this. You can't get this that's what I talk about, financial literacy. That's where I want to go in the future, is to come up with strategies for people in their life cycle, depending on their risk, how much money they've got in super. Are they working? Are they planning on retiring? Do they have to? There's so many variables. Financial planners don't talk about this. They just want to get your money into, a wrap, whatever their managed fund is.
Were they getting their commission? Thank you very much.
Of course. So, and they don't want to get you in property. Financial planners aren't interested in property. So there is a niche in the market. There is a missing pie about superannuation and strategies for people who are in their 60s And then there's people who want to buy properties. Where's their strategies? There's no financial planners selling strategies for super funds for commercial properties or residential. There's also another thing. A lot of people want to buy the home. They want their retirement home. So why not buy that in your super fund? So you rent it out the whole time for 20 years. You retire. You can take that property as a lump sum back to yourself. And in specie, yes.
Let's just break that down a little bit. So you've got
Yes.
mom and dad that bought their property 20 years ago. Their kids have gone through school. They've now got this great big property. They want to downscale. So they're going to sell that property and they're going to buy a little retirement apartment or wherever. How does that work from an accountant's point of view?
There's nothing really to think about there. That's just what people do. But another strategy is you can buy that house in your super fund prior to that. So you know where you're going to live. People want peace of mind, and property market's moving so quickly. So it's more like, okay, I've got this big house. I've got the kids in it. The kids are getting older. They're starting to move out. They find a house they want to live in for their future. They haven't got the cash flow. It's tied up in the house they're in now. Let's buy it in the super fund. Let's buy that house in the super fund. We know we've got it there. We rent it out. They get to retirement age, sell their big house. They can put $300,000 each into super. It's called downsizer. Once you're over 60. So they put 600 chunk into the super fund. They've already got that property in there. They pull the property out. So they're going to lose the rent, etc., because they're retired now. They move into their property. They know they paint it, do whatever they want once they get it out. And they've got 600,000 sitting in super, and they sail off into the sunset, plus whatever other money they've got left over from the sale of their house.
Sweet. That is.
So that's another strategy. That's a really good, because people, especially as you get older, it's peace of mind. You want to know that that house is in your super fund that you're moving into in 20 years' time or 15 years' time. That makes you feel secure in that knowledge.
In other words, what you're suggesting is buy that house now that you are going to move into in 10, 15 years' time.
And you know you are. Yeah, you've already picked, like I've already picked where I'm retiring. I'm not sure about you, Mish. I'm moving to Ballina, East Ballina. I've got my house, and if I can...
We've spoken about it, and we haven't quite come to agreement with where that is, but I'm 100% there with you. I totally agree. I think planning ahead is always far better because, you're buying those properties at current rate. And as you say, you're renting it out and you're getting the tax-free rentals on it.
Yes.
So, yeah, happy days. If you can afford it, then do it.
Of course. But not only whether you can afford it. Most people at that age have got money in super, so they can. Super fund can afford it.
Yes. Yeah.
And why not have it do something for you that you know that you got this peace of mind that you've got that house there when you want to retire?
Let's just throw it around a little bit. Let's just say, for argument's sake, we've got a industry super fund and we want to do the same thing. Can we do the same with an industry fund?
No, they don't touch super. They don't touch property.
Okay. So what would you do in the case if you've got an industry fund and you want to do that? Is that the point at which you open a self-managed super? And
you can have both. You can have both running succinctly. You can have 10 super funds. You can have 5 industry funds. You can have 4 self-managed.
What are the
people don't
advantages?
understand either. There's advantages and disadvantages. So I'm only going to go off that experience that I've had. I've had a client who she's in, I'm not going to mention names of the super fund, she's in the industry fund, but she's great potential, great earnings. Well, she wants to buy a property. So it's like, but I like when my money's getting earned. So she had her salary go 50% of her super fund go into her self-managed and 50% of her SGC super guarantee go into one industry ones. And she kept running them distinctly. The advantage is she gets to have property and she gets to enjoy the fact that she's still got the industry fund that's earning 12% on average. She was very happy. Yes, but she wants the nest egg and wants the property in the super fund that's going up, capital gains wise, going up 10% every year.
Okay, so she's bought the property and it's in.
She wants to take and eat it too.
Yeah.
The only thing is there is more fees. Of course, you've got the super fund fees and the industry fees, but for the peace of mind of knowing that fund, because it's kind of that thing, you take it out of the industry fund.
Yes.
Right. You buy the property. There's a slump in the property market, and your industry funds are going gangbusters.
Yeah. Okay. So
vice versa, industry funds can tank as well. So. You're sort of hedging your bets there when you've got the two going at once.
You've got both going. If you can afford to have both going at the same time.
If you can, which look, there's a lot of wealth in Australia at the moment. They're not that expensive, realistically.
Oh, hell yes. We see that all the time.
There's a lot of money. That I've got clients, and I'm only a small firm. We don't deal with billionaires, but there's enough money to have both going at once for a lot of people in their 50s and 60s. I'm not talking about when you're 20s or 30s. We're talking 40s, 50s, 60s. There's a lot of money in that pie.
So let's just have a conversation with, let's say, our people that are in their 30s to 40s versus 40s to 50s versus 50s to 60s. So what would you advise somebody who's in their 30 to 40s And I'm going to ask you the same question for 40 to
Yeah,
50.
look, it all depends. But let's say, okay, so let's say 30, 40s, you're looking at maybe salary sacrificing a little bit if you can into the
Okay.
super. Yep, a little bit. Just or yourself getting after tax dollars in there, because you can get a tax deduction up to $30,000 a year into super. So let's say you're on $100,000 salary, we're looking at 12% super. 12,000 is already going in. There's 18,000 left that you could salary sacrifice.
Right.
So that's where 30s, 40s, I'd be thinking about that. 40s, 50s, I'd be thinking, okay, let's start to really seriously get some money into super. So let's start looking if you're getting any inheritances. People normally getting inheritances around that age, I'll be honest. So let's start putting some chunks in. Let's start looking at bring forward rules. If they get any kind of inheritance, say a $500,000 inheritance, you can put $330, $3,000 in 1 year, nothing for the next 3 years. So you're starting to look at some big lump sums. You may be thinking about maybe getting rid of your investment property if you were negative gearing and now you're still negative geared and you don't really, or it's become positive geared and you don't want to pay tax on that anymore. How
Yeah.
about we sell that investment property and we buy something in a super fund instead?
Okay.
Let's start shifting our money into super. So that's 40s, 50s,
So
starting to
40s, 50s,
accumulate.
what you're saying is you're wanting to be shifting as much as possible into supers.
Yes, you want to start your outside assets, if they're no longer necessary to outside your family home, maybe start sort of moving them into super. So if you've got shares, you can transfer blue chip shares into super funds. A lot of people have shares or inherit shares. That can happen. Yep. So you can start moving that. So you're really starting to try and funnel your money in between 40 and 50. And usually, like I said, people getting inheritances or selling their business. There's some lump sums coming to people, a lot of people around that age.
No, I was having a conversation with some friends the other day and they're saying, no, their parents are not dying now that they're in their 40s and 50s because of AI and medication. Parents are living longer and longer. So that age has moved now. It's not 40s to
Maybe it is a 50s, 60s. Well, then definitely yes, 50, 60. We're looking at downsizer. We're looking at strategies to get more money in there, downsizing your house, putting your money in there, buying your house for your next investment for your retirement, as we spoke about before. That's probably 50, 60s. So 30, 40s, you're not doing too much, maybe a little bit of salary sacrifice, not really thinking too much about it. 50, 40, 50, you're really starting to try and funnel some money in. And then 50, 60, you're looking at strategies. What do I want to buy in a super fund that's going to help me after retirement? That's where you're looking at. So that's your differences.
Okay, perfect. Well, I think this is absolute gold, Kerry. And I know you are a wealth of information. People love listening to these podcasts. We're going to have to pick your brain a little bit more and get
Definitely.
more
No, I
often.
enjoy it. I enjoy talking about it as well. I like to get that out to people. I think it's something, I wish they taught at school or,
Yeah.
they had some senior classes or somewhere you could go, a hub that you could do this. And maybe one day I might have one, free for service that you can come and just ask these kind of questions or get some kind of really real timely data that's tailored to you and your life stage and your funds and where you are in your life.
Well, I think, Kerry, what we should talk about off air is setting up maybe a little schedule that we can go through these and we can break them up, do them in bite size and maybe do them in a series, which will get your information up there and share that financial literacy with our audience.
Yeah, definitely. I'd be interested in that.
Okay, let's talk about that. Guys, thank you very much for listening, and I hope you got gold nuggets out of that. I most certainly did. I love talking to Kerry. She, like I said, she's a wealth of knowledge, and this is the stuff that if you're not asking your accountant, they're not going to be telling you. So
Exactly. And you don't know what to ask.
Yeah,
Exactly.
there
It's
we
hard
go.
to know. Yeah.
So I'm going to be doing some serious picking of Kerry's brain to put this together and help you out. Kerry, last little bit of, do you have any books that you would suggest our listeners read or any little gold nuggets, anything, a great movie that you've seen, anything that you'd suggest they go along and do in the meantime? Do listen.
No, I think just think what is enough money for you to retire on and where do you see yourself in 20 years? I think they're the two things people need to ask themselves. How much do you need to retire? What kind of, not lump sum, how much per week do you need to live? And then where do you see yourself in 20 years' time?
Fabulous.
They're the two questions, and then work back from there.
Okay, great. Well, thank you for joining us again and looking forward to having you on again.